Hello and welcome. I'm Richard, and this is the Art of Arbitrage. Today, on the channel, we're looking at the proposed takeover of Marathon Oil by ConocoPhillips. I hope you find the content useful, and if you do, I would be awfully grateful if you would drop a like and subscribe. It would really help me with the algorithm and building the channel. So, let's get to it. Marathon Oil was founded in 1887 in Ohio, and is one of the largest oil and gas exploration and production companies in the United States. Marathon was formerly part of Rockefeller's Standard Oil Company until the monopoly was broken up in 1911 and was subsequently acquired by United States Steel in 1982. The company has been independent since 2001. ConocoPhillips was founded in 1875 in Utah, and over the last 150 years, the company has engaged in multiple mergers and acquisitions, including the 2002 merger of Conoco and Phillips Petroleum, which resulted in a move of headquarters to Houston, Texas. Today, ConocoPhillips has operations in 13 countries and produces approximately 1.9 million barrels of oil per day. In May 2024, ConocoPhillips approached Marathon Oil with a proposed $22 billion all-share merger. The proposal represented a 14.7% premium to the closing share price of Marathon Oil on the 28th of May and has been approved by the board of directors of Marathon. The deal is now subject to a shareholder vote and regulatory approval. So, let's take a look at the numbers. ConocoPhillips is proposing an all-stock transaction. This means Marathon Oil shareholders will receive new shares in ConocoPhillips for their Marathon shares, with no cash changing hands. The proposed exchange ratio is that each Marathon share will convert into 0.255 shares of ConocoPhillips. At today's market prices, that means Marathon shareholders will receive $28.56 in ConocoPhillips shares for each Marathon share that is trading at $28.25. However, in order to calculate an overall expected return, we also need to consider the other variables intrinsic to this deal. For every one share of Marathon purchased by an investor, they will have to short 0.255 shares of ConocoPhillips to achieve a risk arbitrage position. If this were done at today's date and the deal closed in the proposed timeline at the end of this year, the investor would have to pay a fee to borrow the shares of ConocoPhillips and would also have to cover any dividends paid during that time. It is anticipated 2 dividend payments will occur before the end of the year, a payment of 58 cents in September and an additional 78 cents in December. The investor will therefore have to pay 35 cents, that is 0.255 times $1.36, to cover the dividend payments on the borrowed shares. The flip side is the investor will receive an anticipated dividend of 11 cents on the Marathon share. So when we plug all of this data into our spreadsheet, an exchange ratio of 0.255 shares, an expected duration of 152 days, a long dividend of 11 cents, short dividends of 35 cents, an estimated downside price of $24 on Marathon, and an estimated upside price of $118 on ConocoPhillips should the deal fail to close. Then we can calculate our estimated returns. An investor taking a position in this takeover today can expect an unleveraged return of 1.1%, which translates to an annual rate of return of 2.63%. However, even with the fair probability of the deal closing, the likely fall in the price of Marathon and increase in ConocoPhillips shares should the deal fail to close results in expected risk-adjusted return of negative 10.31%. If an investor were to apply 50% leverage to the above position, the return would actually fall to 0.45%, or 1.11% on an annualized basis, with a risk-adjusted return of negative 23.73%. This reduction in expected return is driven by the cost of debt, the duration of holding, coupled to the overall low expected rate of return. As we saw with our analysis of the Hargreaves-Lansdowne takeover in the last video, the numbers here don't seem to be numbering, and it is likely that most investors will be able to find better uses of their capital. What do you guys think of this takeover? Let me know in the comments, and don't forget to like and follow if you found this video useful. Be aware that all the figures mentioned are at the date of my calculations and will change in line with the share price of the company, any change to the takeover price, and the duration to close. As always, this information is provided for educational purposes only. You should not consider anything in this video to be investment or financial advice, nor a recommendation or endorsement to buy or sell any financial instrument. You should always conduct your own research before considering any investment and seek independent financial advice. Thank you, and until next time, enjoy life.